Head and shoulders. Most of you have heard of it. It's one of the most battle-tested chart patterns in existence. Traders around the world have been using it in live markets for close to 100 years. But what happens when you flip it upside down? Instead of a signal to sell, it becomes one of the most powerful bullish signals for catching a bottom. That's the inverse head and shoulders. Today, we're going to break it down completely from a long perspective and walk through 3 strategies you can apply right away. If you trade from the short side, just mirror everything we cover today. The logic works in reverse. Here's what we'll go through. Strategy 1. Neckline breakout entry. Strategy 2. Neckline pullback entry. Strategy 3. Early entry at the right shoulder low. Pattern overview. The inverse head and shoulders is made up of 3 lows. The first low is the left shoulder. The second is the head. The third is the right shoulder. The head is the deepest of the 3. The final, hardest push down at the end of a downtrend. The right shoulder is shallower than the head. Price pulls back again, but this time it doesn't break the head's low. That's the key. The line connecting the highs of the left shoulder and the right shoulder is called the neckline. Keep this structure in mind as we go. It'll make everything that follows much easier to follow. Common misconceptions. Before we get into it, let me clear up 2 misconceptions that trip a lot of people up. First one, once the right shoulder forms, it's safe to enter. A lot of traders see the right shoulder taking shape, assume the bottom is confirmed, and go long right there. But the right shoulder forming is not the completion of the pattern. You're only halfway there. The pattern is complete when price breaks above the neckline and the candle closes above it. Entering before that happens means if the pattern fails, you take the full loss. Second one, the neckline is always horizontal. In textbooks, the inverse head and shoulders is drawn with a perfectly flat neckline, but in real charts, a tilted neckline is far more common. Because the pattern forms at the tail end of a downtrend, the head tends to be lower than the left shoulder and the right shoulder a little higher, which gives the neckline an upward slope. A tilted neckline doesn't mean the pattern is invalid. If anything, it's the version you'll see most often in live markets. Fundamentals. The inverse head and shoulders forms at the point where a downtrend ends and an uptrend begins. When the right shoulder puts in a higher low than the head, that tells you selling pressure is fading. When price breaks the neckline, it confirms that buyers have taken control. There's one factor that significantly improves pattern reliability: volume. The ideal structure looks like this. Volume contracts through the head, then picks back up as price bounces off the right shoulder and expands again as it breaks through the neckline. A breakout without volume is a red flag for a false breakout. Always check it. For time frames, use the 1-hour chart as your minimum. The higher you go, 4-hour daily, the more reliable the signal becomes. Strategy 1. Neckline breakout entry. First strategy, neckline breakout entry. This is the most straightforward approach. You wait for the left shoulder, head, and right shoulder to form in sequence, then enter when price breaks above the neckline. The key is confirmation. Don't enter the moment price touches the neckline. Wait for the candle to close above it, then enter at the open of the next candle. Check volume at the same time. If volume is rising on the breakout candle, the move has more conviction behind it. A quiet, low-volume breakout has a higher chance of fading back. Stop loss goes below the right shoulder low. If the pattern is valid, the right shoulder low should act as support. If price drops below it, the pattern is compromised. Close the position. For the take profit target, measure the vertical distance from the head low to the neckline, then project that same distance upward from the breakout point. When price reaches the first target, take off half the position and let the rest run. Strategy 2. Neckline pullback entry. Second strategy, neckline pullback entry. After a breakout, price sometimes retraces back toward the neckline. This is called a pullback or a throwback. That retest is your entry window for this strategy. If the breakout was genuine, the neckline flips from resistance to support. Wait for price to bounce off the neckline and print a bullish candle above it, then enter. The advantage here is tighter risk management. Because your stop sits just below the neckline, your risk-to-reward ratio is more favorable than with strategy 1. Volume helps confirm it too. If volume contracts during the pullback and then expands as price bounces, that's a strong sign the neckline is holding as support. Stop loss goes just below the neckline. If a candle closes below it, the breakout was likely a fake. Exit at that point. Take profit as calculated the same way as strategy 1. Measure the head to neckline distance and project it from your entry. Because this entry comes with more confirmation, you can afford to hold the position longer. Consider taking half off at the first target and trailing the rest until a trend line break. Strategy 3. Early entry at the right shoulder low. Third strategy, early entry at the right shoulder low. Of the 3 strategies today, this one offers the largest potential return. Strategies 1 and 2 both enter after the neckline breaks. By that point, price has already moved up a fair amount. This strategy doesn't wait for the neckline. You enter while the right shoulder is still forming, at the low of that pullback. Because your entry is much lower, you're positioned to capture not just the neckline break, but the full move to the target. 2 conditions must be met. First, the right shoulder low must not break below the head low. If it does, the pattern is invalidated. Walk away. Second, a bullish reversal candle must appear at the right shoulder low. A doji, a bullish engulfing candle, the types we've covered in previous videos. When one of these prints at the right shoulder low, that's your entry signal. The candle is the market showing you directly that buyers are stepping in. Watch volume here too. If volume is lighter at the right shoulder low than it was at the head, that tells you selling pressure is drying up. When a reversal candle then forms with volume starting to tick up, your confidence in the entry goes higher. Stop loss goes below the head low. If the head low breaks, the pattern is gone. Cut it without hesitation. Because you're entering at the right shoulder, the distance to the head low is your stop, and the distance from there to the neckline target is significantly larger. That gives you the best risk-to-reward ratio of all 3 strategies. For take profit, use the head to neckline distance projected from the neckline breakout point as your target. When price approaches the neckline, scale out part of the position to reduce exposure. Once the neckline breaks and holds, ride the remaining position toward the final target. Today we covered 3 strategies. Strategy 1, neckline breakout entry. Strategy 2, neckline pullback entry. Strategy 3, early entry at the right shoulder low. All 3 share the same core rule. Always wait for a candle reaction to confirm the entry, and always check volume alongside it. Knowing a pattern and actually trading it are 2 different things. Keep applying what you learned today, and the setups will start jumping out at you. If you want more chart analysis and trading insights, join our free Telegram channel. The link is in the description. If you found this video useful, please leave a like and subscribe. Your support helps us keep making content like this.